Hello everyone, this is Professor Kent. Today's recording is for chapter 11, Accounting for Depreciation. We're it's volume 1 and we're going to do the examples in order to learn the chapter. So our first example is we're going to learn the theory by doing the examples and also learn the material as we do the examples. The first question is where the first part is learning how to account for depreciation, and there's different depreciation methods that we learned previously, and we're learning it in details in this chapter. So it says equipment with the cost of 10,000 and a residual value of 3,600 is acquired on the first day of the fiscal year. So it's the first day of their fiscal year. The equipment has an estimated useful life of 8 years and expected life of 10 years with no salvage value. So when you have a useful life of 8 years, there is a salvage value, and if you take the asset to expected life, there is not going to be any salvage. So what is the difference? First, we have two things. We have a useful life and we have a expected life. So there's two lives, expected lives. If it's a useful life, it is for 8 years. We have a salvage value of 3,600. Means we can depreciate the asset for 8 years and then we can sell the asset for 36 years. If we take it if it's an expected life is 10 years, after 10 years the asset will be worth nothing. So why do we need to do that? For ASPE purposes, we needed to calculate the depreciation using both the useful life and expected life. Wherever there's a higher depreciation, that's if wherever there's a higher depreciation, that's what we are going to record the transaction at. So we're going to show you how to do it. I'm going to put it under the IFRS, and then we're going to do same thing under an ASPE, and we're going to explain what entry you will be doing if they were following an ASPE standards, and then what entry you will be doing if they were following an IFRS standard. Again, the cost minus your residual value divided by the useful life. In this case, our cost was $10,000. Our our residual value is 3,600. The useful life is 8 years. So what will be, it will be equal to $800. So what we're going to do is we will debit our depreciation expense and credit will be your accumulator depreciation, and that will be $800. So that's what the entry you will do if they follow an IFRS standard. Then going further, we're going to go to my ASPE. If you go to your ASPE 1, we will do the same what we did under the IFRS. 3,600 divided by the 8, it will be my 800. Under the ASPE, we needed to do another calculation to figure out where there's a greater depreciation, and that will be my 1,000. So this gives us a greater depreciation under the ASPE. Our entry will be for depreciation expense and accumulator depreciation for $1,000. So if they start using using this, they will continue using it for the 10-year under the ASPE. So that's our first one is, so of course we take the greater, and that will be my entry for under the ASPE. Going further, what we're doing is we're creating a straight line method, and then what they're using is units of production or maybe expected lives. They're using a straight line accompanied by a crane for heavy construction purposes. The relevant data on the purchase of a crane is as follows. So what we have is we have a cost of the asset is 500,000, and they said that what we have is we're using a straight line method, and if we're using a straight line method, we use it over the life. 5 minus the 50,000, we will have a depreciation of 90,000 per year. Now, why did they give us the productive life? So this is if the question was asking you to do a different type of method, I wanted to explain a little bit more. There's different depreciation method, and this is the one we just did. It is a straight line method, means you'll have a same depreciation per year. So then what we could do is we could also do a diminishing balance. So diminishing balance will be, we could have a diminishing balance, or we have a double diminishing balance. Then we could also have an activity method, which will be another way of saying units of production. So units of production method. Then where we have is fourth one will be sum of the year, yet sum of the year digit method. Digit method, when you do that, what we have is, we this is not used regularly. It's rarely used, but it's still used, and some companies still use it. So these are some of the methods we are going to be learning. Diminishing balance, also we, in this case you could also have a double diminishing. So double diminishing is you will have double the depreciation of a straight line. So these are some of the methods that we are going to be learning in this chapter. Let's go to the next example and learn what how to calculate the depreciation using the double declining. So double declining, so you could have a declining method or double declining method, means deeper you will depreciate the asset double the time of the straight line. So let's see what how do we do that. It says we're going to go back to the previous example, and we did the straight line. Now we're doing it assuming that uh, that the crane has acquired for 500,000. Estimated useful life is 5 years, and productive life is 30,000. Residual value is 50,000. When you are using a double declining, calculate the depreciation by year using the double declining. When we think of a double declining, we have 100. This is the formula: 100 over the life, multiply by the 2 to get your double declining. In other words, you will be depreciating over the every year you will be depreciating 40%. When you're doing a double declining method, useful life residual value is not put it into the calculation. So if I had to do a double declining balance and I needed to calculate my depreciation for the first year, I will take 500,000 times the 40, and that will give me, I don't have a calculator, let me get my calculator to see what will be my depreciation if I had to do a double declining. So my depreciation will be 500,000 multiplied by the 40%, and that will be the 200,000. So your depreciation for the first year will be depreciation will be 200,000. So that's how you would do your depreciation. Again, residual value is not accounted for when you're doing a double declining method, but you cannot depreciate the asset. You can only do depreciate the asset up to the residual value, not more than the residual value, up to that residual value. Now my second method is activity method, that you have seen it before. It is called the units of production method, and they said what will be the depreciation if they use an activity method. Again, activity method is units of production, that you have seen it before. So we have 500,000, my residual value is $50,000. The life the productive life of the asset is 300,000. So not 330,000 hours. And then what did we depreciate in the, what we're going to depreciate? Whatever we used in the first year. In this case, I'm going to do the calculation in one go, and I multiply by 4. I multiply by the 4,000. What would that give me? That give me the depreciation using a units of production. A unit of production, 4,000, and we are gonna do $60,000. So that's what we will do. Again, the account does not change. So debit will be depreciation expense, credit will be my depreciation expense, that will be 60,000. Depends on the method, your depreciation debit amount account and credit account doesn't change. The only thing changes from one method is the amount of the depreciation. Now what we're going to depletion method. So when we're going to look at the next one, is called the depletion method. Recording of a depletion method. How would you record the depletion method? So what happens in it is when we think of it, we have to read the question to see what the question is asking. It says calculate the depletion rate and provide the journal entry to record the depletion, assuming that 12,005 ounces are extracted in the first year. Before we extract something, we needed to know what entry would you do for this type of transactions. A company acquired a right to use 1,000 hectare of land in the Northwest Territory to a mine of a gold. So this is for my natural asset, natural resources. So it could be oil company, could be mining company. The lease cost is, so we want the lease cost, you will learn in chapter 20 when we capitalize the lease. If we benefit the asset over the life, the lessee will be depreciating the asset in their books. So in this case what they said is the lease cost is 500,000. The related exploration and revaluation cost are $1 million, and the development cost incurred in opening mine is 38,500,000, all of which is capitalized. So what happens in this case? The total cost related to the mine before the first ounce of gold is extracted is 40,000. So the cost of the mine is the cost of the mine before we started the operation is 40 40 million. So that's what they're telling us. The cost of the asset is 40 million. So what we have is in this case they told us we have some of the in the lease. What does that represent? We have a lease cost. So this has a lease cost. The lease cost is of 500,000. So that's the lease cost. And then what we have is we also have exploration and evaluation cost. So that is also capitalized when we acquire a right to use a land, so we can extract some of the gold from it. And the evaluation cost is, they told us it's a 1 million. And then the cost of opening the mine will be 38,500,000. So all these costs are capitalized. If they're capitalized, they will be part of my cost. So they will be part of my cost. So the cost is $40 million, and we have the company estimate that the mine will provide approximately 50 ounces of gold. There's nothing going to be left. We're going to extract till the end. So in this case, we estimated that we're going to take out 50,000 ounces of gold. And how much we extracted in the first year? They told us in the question we extracted 12,500 gold in the first year. So this will give me the depletion rate. So this will give me a depletion rate per ounce. So per ounce this is the depletion rate per ounce. How much we extracted in the first year? We extracted 12,500 ounces of gold. So what we will do is we have a depreciation of $10 million. So when it is a net, when we're using a depletion method, what we do is we do not add we do not debit the depreciation expense. What we're going to do is we will debit the inventory, and then credit will be your accumulated depreciation, and that will be for the $10 million. Now in other words, what we're learning from there, what we're doing is when we extract gold, we put it onto my statement of financial position, which is your balance sheet. When we sell that inventory, then what we do is then we move it to statement of income by recording the cost of goods sold. That's when we move it to the income statement. So that's when we move it to income statement when we sell this gold. At this point, we're going to put it onto my statement of financial position. So this will be your debit, and that will be accumulated depreciation will be credit when we have a depletion, when you have a natural asset, and then natural resources asset, and then um, this is how we record our depreciation. It says describe how depreciation will be presented on your company's financial statement. If I were to look at it now, I extracted an inventory of $10,000. How should that be looked on your statement of financial position? What you could, you have a gold mine, that's what we got, and the cost of the gold mine was $40 million. And we have an accumulated depreciation that was $10,000. And what we doing it, $10 million. So then we have a net book value, or you could have a carrying value, and that will be your 30 million. And this will be reported as a non-current asset. So that's will be my non-current asset. So going further now, we have something different in here. We have, it says prepare a journal entry that collagen would record this liquidating dividend. So when liquidating dividend, so what is a liquidating dividend? Is when more dividend is given than the money that you have accumulated in your net income. So what we have is whatever net income we have, we pay out our dividend from the net income. And sometimes what we have is we declare more dividend than what our net income is. Then what happens in that case, if you pay out everything from your retained earning, sometimes what we have to do is we have to give them common shares. So that's what we are going to be learning from this exercise. So what in this exercise, what we have is we have a retained earning. My retained earning is $1,650,000. And they told us in the question, accumulated depletion on the mineral properties 2.1 million. So that's my accumulated depletion that will go on to your statement of financial position. This is called it will be accumulated depletion. So in this case, you could also, instead of doing an accumulated depreciation entry before, you could also call this an accumulated depletion. Some companies do use that. So they use an accumulated depletion account, which is similar to your accumulated depreciation. So now what happens in this case, what we have is we have shareholders common shares. Our common shares are worth 5,400,000. Now this is Collagen's board of director declares and pay a dividend of $3 per share. So what they did is they're issuing $3 per share. We needed to know how many shares do we have. We have a $1 million shares. So if we have a $1 million shares, how much dividend we paid? We paid a $3 million. We declared and paid a dividend of 3. If we paid it, credit will be cash of $3 million. So now what happens in this case? We have a retained earning. They did not tell us anything else. They didn't tell us that we have net income. So what happens is that we have everything that in our retained earning, we're going to give that as a dividend. So the earning that is retained is paid out in a dividend. If it's a paid out in a dividend, you will debit the 1.6 million and 500,000, and the leftover, where they will come out to, it will come out of your common share. So in other words, you will give them the common share. So you will give them the common share. And what are we learning from here? We're learning that uh, what we're learning return on investment, and then we're learning about liquidating dividend is a return on capital. There's two things we are going to do. We have a return on investment. What is your return on investment? And then what is a return on capital? On capital, we can also call this as a liquidating dividend. Liquidating dividend. So if we paid $3 in a dividend, how much of that $3 was a return on investment, and how much of $3 was liquidating dividend? So we needed to calculate that. And if I were to do that in my retained earning, I had 1.6 million, and then divided by number of shares that was outstanding, we will have $65 will be my liquid return on investment, and then the rest will be my called return on a capital or a liquidating dividend. So that will be called a return on capital, or a liquidating dividend. So that's what the question is. Provided journal entry. Did we provide a journal entry? Yes. And then what do we have to disclose? We have to tell our shareholders how much of the dividend is a liquidating dividend and how much of that is a return investment. Going further with this one, there in this case we are learning about fraction year depreciation policy, and that's under the straight line. So we have there are different way of calculating a straight line. First one is a nearest to the fraction, nearest to the full month, half year, and then half year of the acquisition and the disposal, and full year, and none. Full year in the acquisition, none in the disposal, none in the acquisition, and full on the disposal. So we are going to do each one. First one is we will have a nearest fraction of a year. Nearest fraction of a year. When you do that, again, we have a cost of the asset. The useful life is 5 years, no residual value. We got the asset on June 10th. That's when we got the assets on the June the 10th. So when you do that, of course, we're first one we're doing a nearest to the depreciation. How we're going to calculate it? Sorry. Excuse me. So the cost of the asset is a straight line. Cost of the asset is 45,000. Residual value is 0 divided by the 5. My depreciation per year is $9,000. They are saying nearest to the fraction of a year. When you do that, when are we recording this transaction? We're doing it for the calendar year. So if I have a calendar year, or I have a calendar year, so what happens is that from the June to December 31st, how many months? December 31st, how many months? So we have 7 months. So we have June, July, August, September. So there's 7 months. If I include the full June, but it's a 7 months. So when you do a fraction, we have to, in this case, we have a 7 months minus the 10 over 30. Why did we do it? We purchased the asset on June 10th. In June, we have 30 days. So this in this case, we needed to fraction 10. We needed to do fraction of a day. In this case, it will be 6,667, and then what we have to multiply by 6.667, and that is a monthly rate. So you will depreciate $5,000 per year if we will follow the nearest to the fraction year. Now that was my part A. So that was my part A. Your depreciation will be for the $5,000. So part B, what they're saying is nearest to the full month. So nearest to the full month, what happens is nearest to the full month, when did we purchase it? On June 10th. Up to the 15, we call it is the full month. So we will do it for the 7 months. Again, you're gonna do 9,000 divided by 12 times your 7, you will depreciate 50 to 50 when it's called nearest full month, nearest to the full month. Then going to part C, they said half year in the period of acquisition. So what happens is half year, the year of acquisition, the year you purchase, even though we purchase on June 10th, we don't care about the date. Whatever the depreciation is for the year, we take half of that. That's how much we will depreciate in the first year. So that's half of the depreciation in the period of acquisition, the year you purchase and the year you sell. Going to D, it says full year in the period of acquisition, none in the period of disposal. So it doesn't matter when we purchase it, we will take full year's depreciation on the D. When we go to part E, they are saying it none in the period of acquisition. If we're doing this, if we're doing a depreciation, we will do no, there will be no depreciation in the year you purchase. We'll record the depreciation in full year in the year we dispose. So that's what we will do. So these were some of the different method, the different policies the company could have under the depreciation method. My next one is when we calculate the partial period depreciation with the double declining method. So in this case, it's a double declining. They said calculate the depreciation of expense for 23, 24, 25 using the double declining balance. So your depreciate will be doubled. So that's what it will happen. It will double. So in this case, 100% divided by the 5 multiplied by the 2, that will be my 40%. So my first year, when did we purchase? We purchased on October 1st, and then October 1st we have $10,000. That's the cost multiplied by the 40%, and that will give me $4,000. So from October 1st to December 31st, we take it that's the calendar year. 3 months, 3 divided by 12, my depreciation expense will be $1,000. Again, we do not account for residual value when we're using a double declining method, when we're using a declining method. In 2024, we will have $10,000 was the cost. We already depreciate 1,000. That will give me 9,000 multiplied by the 40%. That will give me $3,600. I take it to my 2025. The cost was, you could do it this way, or you could take the cost of 9,000 minus your 3,600 times your 40% gives you 2160. Or in order to get your 9,000, of course you have $10,000 minus the 1,000 minus the depreciation of 2024. It will also give you the same answer. So that will be your depreciation for each year using the double declining balance. So that's what you're going to do. So now next one is we are doing a revision of your estimated useful life. When we think of a residual value or useful life, if they're all estimates, if they're estimates, we don't go back and reproduce our financial statement. We do it prospectively. So this is what we do. We call it prospectively. If it's a change in estimate, you adjust the current year and move on from there. So saying that the next part of the question is that when we revise the life of the asset and the residual value, how do we calculate the depreciation using the straight line method or a double declining method? How do we do that? So let's go through it and see what do we get. I'm just trying to look for my calculator. I got it. So what they're saying, machinery that costs 90,000. So the cost of the asset is $90,000. Was estimated originally to have a 20 years of a life. So 20 years was the life, and the residual value was $10,000. So my depreciation would have been 4,000 per year if they if we finish here under the straight line. We needed to do further. They said that it has already been depreciated over 8 years. Something happened in the year 9, something happened in the 9. So what happens in this case? The cost minus what happens is we have $4,000 depreciation per year, and 8 years are gone by. So what we did is we depreciated the asset of $32,000. And what happened in year 9? Assume that the asset's total life now expected to be 30 years. So the word here is total life. So there's a different way of doing it. If I take a 30 minus the um, 30 minus the 8 will give you 22. And they also said the residual value is $2,000. That will be $2,000. So you will depreciate the asset over 22 years. So that's one way of doing it. Or what you could do is, there's another way. 20 was the original life. The life, total life was, it makes it 30. And then how many years are gone by? 8 years are gone by. So that's how we calculate the 22. So our top number will be 54,000 divided by the 22, and we will depreciate. Our depreciation expense for year 9 will be 2554 instead of the 4,000 that we were calculating before. So that's how this is how actually they also showed you how they got the 4,000, but I redid it. So that's your first one. And the second one is, if the so in other words, you don't go back, you don't go retro perspective, you do it prospectively. You adjust the cost, or you adjust the life from the period that you were aware that there is a change in estimate life or change in residual value. Going further, they're saying, what if the company was using a double declining method, had been used initially? What will happen? So in this case, we have 100 divided by the 20 times the 2. That will give me 10% decline, double declining balance. So what I have is, the way to do it, when you in other words of looking at it, what will be your net to book value on year 9? That's what we're looking for. In order to calculate your net to book value, there's a different way of doing it. The first thing you needed to know is, what is the net book value in year 9 in order for us to multiply by the rate. So this is the rate that we started off with, and for the first 8 years we have used that rate. If you use that rate, what will be, how do we do it? The cost of the asset is $90,000. We know that we're depreciating 1 minus the 10% every year. So how many years did we do it? For 8 years. So then when you do this, you will calculate the net book value, the year that you're starting, 38,742. That's the year 9. Your net book value of the asset will be that. And then when we do that, what do I multiply by to get my depreciation expense for the year? How do we do that in year 9? What happens in year 9? The 100% divided by the useful life, multiply by the 2. So you will depreciate over the 909%. So if I were to do a depreciation, 38,742 multiply by 90909%, and whatever that number will be, that will be your depreciation for that year. 38,742 multiply by 90909%, and that will be 3521.99. So if they were using double declining method, this will be their calculation. And why did we do this? Because we did, otherwise you could sit there and work it out a number for the 8 years, and you do it for each year. You start with the 90,000, multiply by the 10% for the first year, whatever the carrying amount is. multiply with another 10% to get the number. Keep doing it for the 8 years. So we don't need to do that. This is the faster way of calculating the net book value after the 8 years. Now the next topic we're going to go to is the next topic I needed to go to is doing the recovery, the impairment loss. So impairment loss, how do we recognize it, and how do we sorry, I just have to, oh there, how do we recognize it, and what do we do under this? Is the first one is cost recovery impairment model, and it's used by ASP companies when you needed to learn how to do recoverability test. If it's impaired, you need to do a journal entry. If it's not impaired, we don't need to do journal entry. Before we get to it, under the ASP and IFRS different. So they told us the cost of the asset was 800,000, and the accumulator depreciation on that asset is 200,000. So the net book value or the carrying amount is sitting as a 600,000. So that's a net book value or a carrying amount. So that's what my carrying amount is. So that's what they said. The assets carrying amount is 800,000, and they're using an ASP test. ASP, this company is following an ASP standard. Use the recovery test to determine if the asset is impaired under the cost recovery impairment model. So what we has, we're given two things. So they're saying the expected future undiscounted net cash flow from the use of equipment later is estimated to be 650,000, and fair value is 525. At this point, I just wanted to tell you, when we do a recovery test, what we do is we compare the carrying amount to undiscounted undiscounted net cash flow. We compare it to test, just to test. For when we do the entry, we take the fair value. In this case, on a discounted net cash flow from this equipment, in this case it is 650,000. So we want to know, you have to compare. If it's an ASP, you compare to do under the ASP, you compare the amount of undiscounted net cash flow to your carrying amount. If this is more, the asset is not impaired. So an asset is not impaired if the undiscounted amount is more, is not impaired. If the asset amount is less, then your the undiscounted cash flow is less, then we will have an impairment. If you have an impairment, then you have to do a journal entry to record this impairment. We're going to do the couple questions going forward to show you a little bit more when there's a less, when there's more, and how do we do a journal entry. Going further now, so they said so now they changed the question. And what did they change? They said the cost of the asset was 800,000, and we know that the accumulator depreciation was 200,000, and my net book value was 600,000, or carrying amount in our books was 600,000. So what they said is, they said undiscounted cash flow from the equipment are 580 instead of what we did. So what is my undiscounted cash flow? Undiscounted cash flow is 580,000. It is less than the carrying amount we needed to do. This becomes, it is less. If it's a less, is it impaired? My answer will be yes. When you do an entry, if your answer is yes, there is an impairment, we needed to record a journal entry. We needed to record a journal entry to get the amount. You needed to, I'm going to change the ink, you needed to compare it to the fair value to do the adjustment. So my fair value is 525, that is given to us in the question. So the impairment amount will be 75,000. So first you compare it, you when you're doing a recover when you're doing your test, you compare to undiscounted amount. But when you're doing a journal entry, you journal entry will be the difference between the carrying amount and your um, fair value. So when you do that, your entry will be debit to loss on impairment, and credit will be accumulated impairment loss on equipment, and that is your $75,000. Going, this is when we did it, we just did a cost recovery model. So we're doing a cost recovery model that is used by companies if they're following an ASPE standard. If the company is following a IFRS standard, they will use something called a rational model. So IFRS company will use a rational model. Their way of doing calculations will be different, but in this case, we are going to do what we know first. Cost of the asset was 60, accumulated depreciation was 15, and that's how we got the net book value of our asset. And that is my carrying amount. That's the value sitting of the property value sitting in our thing. Under the IFRS, we have to go a little bit further. And what we have is we want maybe impaired due to tech, technological obsolescence, the assets value in use. So first we have is value in use. Then we have fair value less your disposal cost. So the fair value in this case, we have, they said the assets value in use 47,500, and the fair value less cost of disposal of 2,000 is $40,000. So fair value less disposal is the amount that when you're doing a rational model, first you compare those two, you get the higher amount. So we were going to get the higher amount. What is the higher amount? My higher amount is 47,500. We compare it to my net carrying amount. If higher amount, if this is a more, then no impairment. So if this amount is more, then no impairment. If this amount was more, then there's no impairment. If this amount was less, we will have a yes impairment, and you will do an entry. We're going to go further, and there it's going to make you what does this amount called? This amount is called a recoverable amount. If you were to ask a multiple choice question, the difference when you compare the fair value less disposal and value in use, when you compare the both, then what we do is we call it a recoverable amount. So if the recoverable amount is more than the net book value, it is no impairment. If it was less, there is an impairment. Now we're doing the same question under ASPE and IFRS, and they are going to be asking you to do a journal entry. So let's do the both there. First we're doing a rational entity model, and then we are doing the cost model. So let's do my entry and then see what they're doing. So first one, let's do a rational impairment model, rational entity model, and that is used by if a company is filing an IFRS standard, and the cost recovery impairment model is used by ASPE companies. So that's what is used by an ASPE companies. So what we have is we have a cost of the asset, and we have an accumulated depreciation, and we have something called net book value or carrying amount, and that is your 45,000. I'm just going to take it further. This is your 60,000. This is your 15,000. Maybe impaired due to a technological obsolescence. Assume the assets value in use. When you do a value in use, that is used by IFRS. So I'm going to take a value in use, and that is my 37,500. So that's value in use, and then what we needed to do is we compare it to fair value less disposal. In this case, fair value less disposal, and the amount is $40,000. So we take the higher amount, that becomes your recoverable amount, that is $40,000. Is this impaired? Yes, it is impaired. So it is impaired. Yes, it is impaired. If it says you have to do an entry, in this case, when you're doing an entry, you will take the difference, and that will be your entry for $5,000. And the entry, the account is same, loss on impairment, cumulative impairment loss, and that will be for the $5,000. So if the company will filing IFRS, that's what they do. Going further under the cost recovery, again you have a cost, you have an accumulated depreciation, that doesn't change. This is 15. That is my carrying amount, or net book value is 45,000. And when you're doing a cost recovery model, what we look at is we look at the undiscounted cash flow, undiscounted net cash flow, and that is your 43,000. Is it impaired? Yes, it is impaired. Yes, it is impaired. When you do that, we will have to do an entry. What we are going to do, you have a in this case we compare it to the fair market value. If I were to do a compare to the fair market value, they told us in the question the fair value minus your disposal is equal to $40,000, and I should put it in here, it is $40,000. So when you do that, we know we had a disposal cost of $2,000, and that what that give you my fair value of 42,000. So when we're doing an entry, we will do an entry with the, you compare it to the fair value, your entry will be for the 3,000, the entry will be exactly the same, the amount is changed, loss on this case. You could also say equipment, and your entry will be for the $3,000. You compare it to the with the 42,000, not with the 40,000, not with 40,000, you compare it to the 40,000. So that's what you're going to do. So let's look at the next one. Sometimes what happens in this case is that the calculation of an impairment loss on an asset group, when there's a, you have a group of assets, and when there's an impairment, and how you do the impairment in this case is a manufacturing that produced part of the residential telephones. Recent indicators are that the market for this product, the market for this product is continue to the for this product likely to continue to decline significantly, and the LLI is testing equipment use and production process for impairment. So what happens is, this is the cost, this is the accumulated depreciation, that's the net book value of each asset. So we don't know which, and this is a group, this is all goes in a one group, but we don't know which one is gone down in a price, which one isn't gone down in a price. When the total cost of dice and specialized equipment cannot be used anywhere else, so they cannot be used, so these two cannot be used anywhere. Used anywhere. So if they cannot be used anywhere, so what we needed to do is we needed to see what entry we could be doing. And then while the general equipment, can be sold for $15,000. So this can be sold for $15,000, less the disposal, which is your $1,000. LLP 15,000 less the disposal. That's what it means. LLI plans to continue producing the part for the 2 more years to fill the commitment to this customer. The net future cash flow from the next 2 years production part and disposal of an equipment are estimated to be 30,000, and the present value of the cash flow is 26,000. So what we have is we have a recovery model. In this case, it's an ASPE, it's a cost recovery model. So if it's a cost recovery model, what we needed to know is what is the carrying value of the unit. The carrying value of the whole unit is 31,000, and they told us in the question that is 31,000. So that's the first thing. And then what we needed to do is we needed to compare it to the undiscounted amount to see if there is an impairment. So we needed to look at my undiscounted amount, and in this case my undiscounted the net future cash undiscounted future cash flow is the net future cash flow is your 32,000. We want to know, are they impaired? No, they are not impaired. If no impairment, if there's no impairment, there's no entry. No entry if there is not impaired. Did they ask us to do it under IFRS? Yes, they are. So we're going to do the next part of the question just right there under the rational entity method. So under the ASPE, if the company was following an ASPE standard, there's no entry. Under the IFRS, we might have an entry, and what we have is we have a carrying amount. In our carrying amount of the unit is 31,000. We compare it. Before we can compare it, what we need is they told us we needed to know value in use, and we have a fair value less disposal. So fair value is, they told us in the question, fair value will be 15 minus the 1. So if I were to take that 15,000 minus the 1,000, that is your 14,000. So if they don't give you value in use, if you look at it, present value is same thing saying as a value in use. So 26,000, we take the higher amount, which is 26,000. Is it impaired? That becomes also recoverable amount. Is this impaired? Yes, it is impaired. So because the 26,000 is lower than the carrying amount, and what I needed to do is I needed to do an entry. So in other words, I will have to that's my recoverable amount. I needed to do an adjustment for 26,000 recoverable amount. I needed to do an adjustment for $5,000. So when you're doing it 5,000, you debit the loss on impairment. In this case, what we have is we don't have, all the assets are not impaired. The only asset that are impaired is the first two, the one with value of 4,000 and the one with the value of 15,000. So when you do that, when it's a group, what you're gonna do is you needed to add the value carrying amount of both assets that are impaired. In this case, it is 4,000 divided by your 4,000 plus your 15,000. Then I take my 15,000 divided by your 4,000 time plus the 15,000. So what I have to do is I needed to multiply then by 5,000 to see how much should go to my tool and die and how much should go to my specialized equipment. Multiply by $5,000. The first one will be 10,000 1,050. The second one will be 3,950. And when you do an entry, debit will be loss and impairment of $5,000. Credit will be your accumulated impairment loss on tool and die, and the next one was specialized. In this case, first one was 1050, the second one will be 3950. Going further to the next one, we're gonna go and see what the question is asking. It's a disposal as disposal of an asset held for use. Any asset that is held for use, we do not do a depreciation on that. So that's what the theory behind is, that any asset that is held for use, um, held for sale, we don't do a depreciation. If it's held for sale, we do a depreciation. So there's two words we're looking for: held for use, you're using it to produce revenue, and held for sale. If it's held for use, we take the depreciation, and if it's held for sale, no depreciation is taken, because we shouldn't be we shouldn't be using that asset. That is just to sell it. So provide the journal entry at the time of the disposal and calculate the routine gain or loss on a disposal. So what happens in this case? We want to know if it was used. So they, in this case, is this held for use? 18,000 has been used. That's what it is. So if it's used, so we needed to know what is happening and how long it's been used for. They said the 9 years and depreciated at the rate of $1,200 per year. The machine is sold in the mid of 10th year. If it's a mid of 10th year, means 9.5 times your 1200, that will give me the accumulated depreciation that we have taken on the asset. That will be 11,400. And what was the cost? The cost was 18,000, and that's my accumulated depreciation. The net book value was 6,600, and we sold it for, we proceeds that are coming in 7,000. So it's more, if it's a more than what the cost is, what is the net book value, we have something called a gain on a disposal. When you do an entry, it's just like a getting rid of the asset. You will debit the accumulated depreciation of 11,400. My cost of your asset, which is in this case your machine, will be a credit of 18,000. And then what we did is we sold it for 7,000. So we will be receiving cash for $7,000. The difference between the both, which is your $400, that is a gain. Gain is a credit, so we call it gain on a disposal of asset. And that will be your $400. Going further to our next one, and that's the two things, those are the two last things we needed to do, is saying that disposal of an involuntarily conversion, means you didn't want to sell it, involuntarily happens. What are some of the reason that you could have an involuntary conversion? It could be a fire, could be a natural disaster, or due to maybe major highway. In this case, this is what it is. If the government wants to take over your property because your property is in the middle of where they wanted to create a highway or build a highway, a company is forced to sell its building. So you're forced to do that. Why? Because the building that stands directly in the path of planned major highway. For several years, provincial government has tried to buy the land which the building stands, but the company has resisted. So the company didn't want her to sell it. Now they're forced to do it. The government ultimately exercised the right to expropriate, and court has upheld this action. The settlement, in the settlement, the company received 500,000, which is higher than the net book value of the asset. So how would you record that? So in other words, the company, they're paying you. What are they paying you? They're paying you, I don't know what they're paying you. We needed to know what we're getting. So we're getting receive 500,000, which is higher. So you're getting two things. You're getting $500 for the building, and you're getting 100,000 for the land. So what we're getting, both land and building. So the book value of the land was 100,000, so you're getting 100,000 of that. So I get rid of my land. My land will be $100,000. I got rid of my building. The building is 300,000. I already got rid of that. Then going further, we have accumulated depreciation on the building, which is $140,000. So there is no accumulated depreciation on the building, sorry, on the land, because land does not depreciate. And then we received cash, 600,000 if we received cash. And then what we have is, we have a gain on a disposal. So let's do that. Gain on disposal. And how we're going to do that, you have the net book value of your building is 160,000, net book value of your land is 100,000, and altogether the value is 260. In this case, you are comparing it. What would you compare it to? What we are getting. So in this case, you will have to compare it. And then what, for land there is no gain and loss, but in this case, what we, the value of your uh, yeah, so 260. So overall we have a gain of 240. So what they're giving you are, see, 50,000, which is much higher. So did our entry balance, I don't know, did our entry balance of 5, sorry, it's 5 here, sorry, it's 500 here. That's what we received. So our entry should balance 300 plus the 100 plus 240. 640. Yeah, 640. So what we got is, we are getting 500,000. Difference between the both is 240. I thought I made a mistake, so I did make a mistake. So the value we're receiving from the government is 500,000. I think I previously said 600,000 by mistake. Going further, and sometimes what we wanted to do is, we wanted to donate our property. So that's the next thing, is when we wanted to donate our property, and what entry we have to do when we're donating our property. So I'm just waiting for my screen to come back. It says Klein Industry donates property with a fair value of 120,000 to the city of Saskatoon for a park. The land's book value and fair value was 30,000, and the building on the site, the cost was 90. The and the accumulated depreciation to contribution rate is 45,000. So how would you do a donation? So first, let's get rid of our land. My land will be credit of $30,000, and I'm gonna get rid of my building, small building, and the value of the building was 95,000. That's the building of 95,000. And then when we go further, and then I have an accumulator depreciation, and that is your 45,000. And then what did we get? We got what did we get? We got, they said the fair value of the property that we donated was 120,000. So what we're gonna do is, we will have a something called contribution expense, that when you donate something, we call a contribution expense of $120,000. So instead of us giving them the cash for the donation, we gave them land and a building. If I were to think about it, what's happening with it? Where do my entry doesn't balance? So the cost of the asset was 95. The accumulated depreciation on that asset was cost was 95, and the cost the value of your this the value of your building was uh, 50,000, and the value of your land, which is same, is 30. So they both were worth $80,000. What did we get in return? We got 120,000 in return. What we have is we have a gain of 40,000. So we have to record a gain on a disposal. So this is your building and this is your land. So both assets are worth 180,000. Both are worth $80,000, and the fair value of those assets were 120. If I compare the both, I will have a gain of $40,000. And this was chapter 11. Thank you for watching. If there's anything else you want me to record, please um, uh, reply to the video underneath the video, then I will record a next one. If there's anything needed to be done, please subscribe to my channel so that you get access to the new videos as I post them. Thank you so much for watching. Take care and bye for now.